You find the car you want, take the test drive, and sit down across from the salesperson. But before you discuss the total price of the vehicle, they ask a specific question. What do you want your monthly payment to be? You give them a number, they run the math, and you sign the paperwork. Driving off the lot with a fixed $600 a month payment feels like a victory because you kept the purchase within your budget. But by agreeing to that single number, you've simplified your finances in a way that benefits the dealership's bottom line, not your own. That $600 acts as a focus point. Dealerships prioritize this number because if they can get you to look at your life in 30-day increments, it prevents you from seeing the actual mechanics of the loan you're about to carry. By prioritizing monthly cash flow over the total cost, you trigger a series of mathematical penalties. These costs start small, but they compound against your net worth for years to come. To understand how this works, we have to look at the actual equation of car ownership. Right now, that $600 monthly payment is the only variable we can see clearly. This chart shows what happens the moment you leave the dealership. This is depreciation. As soon as those tires hit public pavement, 10 to 20% of the car's value evaporates. You are now locked into a flat payment for an asset that is guaranteed to lose value every single day. The gap between what you owe and what the car is worth begins to widen immediately. To keep that payment at $600, lenders often stretch the loan term. They move the timeline out to 72 or even 84 months, spreading the cost over a longer period to make a high-priced vehicle look affordable. When we look at the math for a $35,000 loan at 8% interest over 6 years, the true price comes into view. By the time the car is paid off, you have handed the bank $9,000 in interest alone. The profit model relies on this manipulation of time. By extending the term, the dealership quietly inflates the total amount you pay while you remain focused on that fixed monthly rate. The bank's interest is only the first layer of the equation. We also have to account for the physical costs of kicking that vehicle on the road every day. Owning the car requires consistent spending on insurance premiums, fuel, and routine maintenance, costs that are often omitted when people calculate what they can afford. Watch how these slices expand the pie chart. When you add up the loan, the gas, the insurance, and the upkeep, that $600 starting point grows into a total monthly cash drain closer to $1,400. The vehicle functions as a constant drain on your monthly resources, requiring significantly more than that initial $600 to stay operational. This brings us to the final hidden variable of the equation, opportunity cost. This is the measurement of what that $600 could have earned for you if it had been put to work in an appreciating asset instead of a car loan. Imagine an alternate scenario. You buy a reliable used car with cash, eliminating the debt entirely. You then take that same $600 every month and route it into an investment account. This graph tracks a $600 monthly contribution into a broad market index fund, like the S&P 500, which has a historical average return of 8 to 10%. After 6 years, the length of the original car loan, you have contributed $43,200. But because your money was growing, the account balance is now over $55,000. By avoiding the payment, you flipped the script. Instead of paying interest to a bank for a depreciating car, you are earning interest on an asset that grows in value. To see the full impact, we have to look past the 6-year loan window and view this over a 20-year horizon. Most buyers repeat this cycle, trading in one loan for another every few years and remaining in a permanent state of payment. If you continue to invest that $600 a month for 20 years, the power of compound interest takes over. Your portfolio grows to over $350,000. This is the ghost wealth you gave up. It is the invisible price you paid for the privilege of driving a new car every few years. While the investor has a $350,000 nest egg, the person in the payment cycle has nothing but an old car and another upcoming loan. Wealth is built through the assets you own, not the monthly payments you can manage. Before you sign for your next car, look at your own equation and decide which side of the graph you want to be on.